Well, hello everybody, and today, that's right, we're going to take a little dive into the lovely Disney stock. We're going to see if it's a buy right now. Is it worth buying Disney stock? Obviously, there's a lot of negativity going around with Disney stock. We have an article coming out today, which is specifically why I'm making this. So Disney was down post-market because Wells Fargo has downgraded to equal rating. It's forecast zero park attendance for the second half of fiscal year 2020. Zero. Zero park attendance? What? And 50% capacity in fiscal year 2021. So here he says, we don't think parks can get back to anything close to full capacity while testing and/or vaccines are far more ubiquitous. Okay. As far as other parts of the Broadstorm company, or Broadstorm phase, the company National Broadcast and Sports will see advertising CPM compression that will become structural beyond coronavirus recession, while the studio segment is taking a hit from closed movie theaters. The company's in better shape because it will ultimately break the theatrical window, then it tap its premium video on demand capabilities. Cuts to a 107 price target, which is actually an upside, but pretty much getting a big old bash here at Disney stock, right? So I decided let's do a little analysis and let's just take a look. I thought the best way to do it is look at last year's full year results. So here we have last year's full year results. Complete full year results. Can you believe it? So what do we have here for full year results? So obviously we're looking at the side on the right here, which we will go ahead and highlight. It's going to be this Parks Experience and Products Network, okay? So for this number here, we are just going to assume that if this guy's anywhere, trustworthy, we're going to assume, and this is obviously full year ending last year, is this $26 billion mark here. We're going to assume that they have a $0 revenue on this for the full year. Now, obviously that's not feasible. It's just frankly not how it's going to go. They've already made money this year, halfway through the year. Not a shocker. And as far as products are concerned, they're certainly making more on products than ever. There's been articles about people buying more stuffed animals and stuff like that than ever. But we're going to assume this segment is entirely zero, okay? And when we do this, we're not going to assume anything regarding the direct-to-consumer basis, which is going to be your Disney Plus. So we're going to assume that they gain nothing from Disney Plus, which is obviously completely false because they will gain more than ever. But we're going to assume that it just stays the same, and all we do is get rid of Parks and Experience. So that puts our, instead of an annual revenue of $70 billion, let's say, it's going to put us in the $42 billion range, $44 billion range, because we're taking this $26 billion out. $46 billion range. So I took a look here. How do we value this stock, right? What is the valuation going to look like with that annual revenue there of $46 billion, which obviously is not going to be accurate, but let's just say it was. So I went back and looked at some of the revenue chart here. $46 billion. Last time that Disney did $46 billion in revenue was 2013, right? 2013. So you look at 2013. Let's go to the max lifetime of this stock. 2013, let's say Disney stock was somewhere in the 60s, right? So does that mean the stock's going down to 60? Well, I mean, if you listen to some of the fear-mongering analysts, there's a chance. But if you listen to anyone with a brain, that's not happening. So here's why I would like to counter-argue this argument. I'd like to counter-argue Wells Fargo's analysis here. First off, just the idea that there's going to be zero attendance between now and the year end in September is just absolutely absurd. It's just not how it's going to go. I'm just going to be 100% honest with you. Even with the worst estimates of this shutdown being the end of, which is in June. In June, the worst estimates are that we're going to have everything shut down until June. I already know for a fact, and you already know for a fact, we've got people that freaking want to go to Disney World and Disneyland as is. Okay? Once we get done with this shutdown, people are going to immediately be planning vacations. Immediately. It's a fact. They're going to want to go on cruises. They're going to want to go to Disneyland with their kids because they've been stuck indoors with them all the time, and they've been able to do nothing. The kids have been able to do nothing. They've had no summer vacation. So we're assuming the worst timeline here of June. Kids have had no summer vacation. They couldn't do anything with friends. So now they're going to take them on vacation. Obviously before the end of the year because they can't go on a cruise in the winter. They're not going really to Disney World in the winter, obviously. So what's going to happen here is, that's right, they're going to have a lot of traffic here in the second half of the year for them. I mean, no doubt. We're talking about after, July, August, September, big months for them. Big months for them in terms of that. They've already had big months, actually, this year so far, as far as their fiscal year from September until around the January period, February period. They were really, having a great year so far. So that zero number is obviously completely illogical. But they're going to have a good revenue number, I believe, coming in from, just those last 3 months of the year. That last quarter for them, I think, is going to be a good one in terms of parks and entertainment, honestly. So they have that going for them, no doubt about it. So that's just the parks sector. That's what I'm going to argue on that. 50% capacity next year, too, I think is just absurd. And I think this guy, if he has ever studied psychology, clearly these analysts don't study psychology. They don't understand how the human brain works. They just frankly don't. And I know a lot of people struggle with it, but we're right now on a darn near, we've got only 8 states that are not even locked down right now, okay? We've got full government mandate. You're not supposed to be going out of the house. Have you been outside? All right. Let's just be honest. Every freaking person is still going out. It is a fact. No one cares about the guidelines. No one cares about that. People care about themselves and their own enjoyment. They're going to be going to Disney World, even if it's ill-advised. Some people won't. It might turn some people away. Not going to turn 50% of the population away, I'll tell you that much. And especially by next year, when we have, first off, a vaccine for something that's not really going to be as relevant nearly by the time of, the start of their fiscal year and the end of September. Not really going to be relevant. By that point in time, we're again going to have flu being a bigger threat. Stuff like that. And just as infectious, just still, regardless. All I'm saying here is this $0 of revenue, park revenue, is just absurd from this analyst. It's absolutely insane. And in the meantime, what does Disney gain in the meantime? Well, they gain the fact that more people are streaming than ever. More people are streaming than ever. Just how many subscribers spending more time? So while the television industry as a whole saw a 20% increase, just the television industry, can I get that clear? So yes, the media networks are going up here for Disney, just from the media networks too. We're not even talking about streaming, because people obviously are watching more television. They have more time to watch television. Think about your ABC News, everything Disney owns. They've got all of it. They've got Fox assets now. HBO Now saw the highest usage on the platform since summer. Highest usage they've seen. The percentage of people binge viewing series has increased 65%, while movie watching is up 70% on HBO Now. And I darn well know that's translating over to Disney Plus, and you know it is too. They're only going to seek to benefit here. Disney Plus is going to gain. It's just going to gain users like no other. And on top of that, I don't know if you heard this, but that's right. Disney Plus launched in India. And first off, this is a place that obviously struggled without even having internet for the longest time. Majority of the country didn't have internet, and now they do. And guess what? A lot of people are going to be getting Disney Plus there. I mean, there's such a dense population there. The potential in customers is massive for them, and I'm pretty excited to see what those numbers look like. But overall, I think this analyst has lost his mind. I think he's bashing the company too much. I did see someone in the comments of that article say that the stock's going to be $20. Just sometimes you wonder why people are so stupid, but the stock's going to do fine. If you think about companies that are focused, and even if we do with the $0 parks revenue, companies that are focused on streaming, which this is going to be massive streaming growth this year for them, the valuation does not matter. It just frankly doesn't. Even with a company like Disney, who's a very consistent value play, always usually pretty fair value, and you saw it with the recent run at 140. This was before we even saw major impact in revenue because of Disney Plus. And that's right. Without even seeing that, we still saw the stock go up to a PE ratio of around 30. Think about a company like Netflix that was trading at a obviously non-existent PE ratio because they didn't make profit, but they were existing at a PE ratio at one point of 400, 500. I mean, this stock was trading ridiculously well. Investors are hyped about tech companies. They always are, and they increase the valuation that way. The one thing I think will hurt Disney in the meantime is that there is a lack of profit to be seen in the streaming industry for them right now. Before they get too developed, there's a lack of profit to be seen. So you could see EPS numbers decline, but again, valuation isn't going to be really the key for this stock. Investors are going to buy in because of what's going on with it in the streaming service. That's just frankly how it is. Alright, I think I've ranted enough. I hope you enjoyed. I'm going to keep buying Disney stock. Just telling you how it is. I'd prefer it right around the 95 range, but, I'll keep looking at it, see if it drops down again. If it does, I'll pick up some more.